Hi, and welcome back to the Food Fund, where we analyze investing in food stocks. If you love food and love buying food stocks, beverage stocks, and restaurant stocks, you will love this channel. In this video we will be analyzing if Wingstop stock is a buy.
All I want is Wingstop!
That's a little excessive.
Why?
That's a little excessive.
Wingstop, stock ticker symbol WING, is just one of many companies we explore on this channel. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Wingstop. Wingstop was founded in 1994 when the first location opened in Garland, Texas. The chain quickly gained popularity for its flavorful chicken wings and has since expanded rapidly, with a focus on offering a variety of bold, distinctive flavors. Wingstop has become a go-to destination for those craving delicious wings. Today, Wingstop boasts a global presence with over 2,200 locations worldwide. The company employs thousands of individuals and has its headquarters in Addison, Texas. Now let's look at the price action. Starting with the 1-year chart, we see that Wingstop had a CAGR of about 138%. Zooming out to the 5-year chart, we see that Wingstop had a CAGR of 31%. Wingstop share price has been on an absolute tear. This is amazing growth. Kudos to the investors. If we perform a backtest comparison of investing $10,000 in Wingstop versus the S&P 500, we find some strong results for Wingstop. In that comparison with the S&P 500, a $10,000 investment in Wingstop would have significantly outperformed the S&P 500 over the same period. Wingstop achieved an annualized return of 40.64%, while the S&P 500 only reached 14.46%. This translates to an ending balance of $49,109 for Wingstop compared to $18,781 for the S&P 500. Wingstop's performance was also more volatile, as evidenced by its higher standard deviation of 55.22% compared to the S&P 500's 18.59%. This means Wingstop's returns experienced greater share price fluctuations. However, despite this volatility, Wingstop still managed to outperform the S&P 500 in terms of both the best and worst annual returns. In the best year, Wingstop gained 87.25%, whereas the S&P 500 gained 28.75%. Conversely, in the worst year, Wingstop's decline was 17.01%, while the S&P 500 fell by 18.17%. Maximum drawdown, which measures the largest percentage drop from a peak to a subsequent trough, was lower for Wingstop at -55.03% compared to the S&P 500's -23.93%. This indicates that Wingstop's losses were more severe during its downturns. Finally, Wingstop's Sharpe ratio and Sortino ratio were both higher than the S&P 500's. The Sharpe ratio measures excess return per unit of risk, while the Sortino ratio focuses on downside risk. Higher values for both ratios suggest that Wingstop generated better returns relative to its risk. Wingstop has significantly outperformed the S&P 500 over the given period, demonstrating superior returns and risk-adjusted performance. However, it's important to note that past performance does not guarantee future results, and investors should consider all factors before making investment decisions. Now let's hop over to market share and take a look at Wingstop's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurants and see that Wingstop is categorized as a fast food restaurant. Expanding the fast food restaurants tab, we can see that Wingstop has the smallest market share of the fast food restaurants covered here, but does appear to be growing. Let's look closer at the year-by-year changes in market share. So we come over here and type in the ticker symbol for Wingstop, WING, and see that the market share is just 0.07% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Wingstop is not attracting a lot of food spend, but it is growing market share very rapidly. The 5-year market share CAGR for Wingstop is 16.02%. This means that Wingstop's market share essentially doubles every 5 years. If we start in 2020, we see that the market share was 0.041%, 0.04% in 2021, 0.045% in 2022, 0.056% in 2023, and 0.069% over the trailing 12 months. From this, it is very clear that Wingstop has been an absolute juggernaut in capturing market share from their competitors. Let's take a look at the fundamentals. Gross margin is 48%. This is very high and handily beats several of their competitors. Revenue has compounded at around 25% over the past 5 years and has reached over $546 million most recently. Wow, that is a lot of chicken wings. Looking at cash flow, we see a 28% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 77% CAGR. As a result, free cash flow has grown at a 19% CAGR. Despite capex increasing as Wingstop continues to try to grow their footprint, I think the spend represents a good investment in the company's future, as evidenced by the growing free cash flow. This is a great company. Weighted average shares outstanding have fallen slightly over the last 5 years, going from 29.8 million shares in 2020 to 29.6 million shares most recently. Wingstop has been buying back shares. This is a great perk in an excellent company. Wingstop is using excess free cash flow to buy back shares. My only concern here is that Wingstop has not been undervalued for years, which means that management is consistently buying back expensive shares. That said, it does look like Wingstop tries to time their share buybacks to occur during market dips. Now let's view return on invested capital. Return on invested capital has risen from 31.9% in 2020 to 37.7% most recently. This is great improvement. Wingstop has become more efficient in driving profits from its investments and has been doing so for a few years now. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -3 days in 2020 to 0 days most recently, Wingstop has gotten a little less efficient over time and is trending to do even worse in the future. Still, 0 days is a very good value. Now, let's look at Wingstop's debt. The net debt to EBITDA has fallen substantially over the past 5 years, going from 7.1 in 2020 to 4.2 most recently. This is a major improvement for the company, especially considering the high cost of debt. Last, let's explore dividends. Current dividend yield is a tiny 0.3% with a dividend payout percentage of 27%. Wingstop is paying out dividends that its earnings can support. This indicates that the company's dividend practice should be sustainable. Dividends per share for this company have grown at a 16.3% dividend per share CAGR over the past 3 years and a 19.6% dividend per share CAGR over the past 5 years. Wingstop's dividend history is clearly healthy. The fundamentals of Wingstop are pretty good. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the food fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Wingstop. It is a restaurant company with a gross margin of 48%. The 5-year revenue per share CAGR is 25% and the 5-year free cash flow per share CAGR is 19%. This is nice. Steady revenue and free cash flow growth coupled with a good gross margin. A return on invested capital of 38% is great and seems to be continuing to grow. Next, the cash conversion cycle of 0 days is great. It seems that their operational leverage is still firing on all cylinders. Concerning debt, a net debt to EBITDA of 4.2 means that it would take Wingstop a little over 4 years of earnings to pay back their debt. So from a fundamental standpoint, Wingstop still looks great. Now let's switch our attention over to valuation. Wingstop is overvalued relative to the S&P 500 with a ratio of 4.3. The price to earnings growth, or PEG ratio, is 3.9, indicating that Wingstop is overvalued relative to their projected earnings growth. Wingstop is still a fundamental king of a company. Great revenue and free cash flow growth power investing into expansion, which in turn generates more revenue and free cash flow growth. It is a virtuous cycle. However, all of that virtue comes at a steep price. A PEG ratio of 3.9 is a pretty high premium, but great companies often command a high premium. While we are moving into more economically challenging times and there is a risk that the share price could come down if the company doesn't continue to perform well, I do think that the chicken wing shop is pretty resilient. Given the many competitors that are currently in the space, it is amazing that Wingstop has managed to continue to grow. I don't foresee any new competitors causing trouble. There is really nothing bad to say about Wingstop. For those comfortable with the risk and believe in the long-term growth prospects, Wingstop might be worth considering, but more risk-averse investors are likely looking for a pullback in the price before jumping in. For me, Wingstop for sure is going on the watch list because I like the long-term growth prospects and I'm also looking for an attractive entry. Many thanks for watching. What do you think about Wingstop and their expanding market share? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.